What's going on with Eastman Chemical? The stock's been drifting lower and investors seem to have forgotten about it. But at Insightful Value, we keep an eye on industrial names that quietly slip into undervalued territory. And this one might just be a sleeper pick. This review is for informational and educational purposes only. It's not financial advice. If you want more sharp, data-first breakdowns like this, hit the like button and subscribe to the channel. Eastman Chemical is a specialty materials and chemical company based in Tennessee. It produces a wide range of advanced materials, additives, and specialty chemicals used in everything from automotive parts to electronics, packaging, building materials, and even cosmetics. Its most well-known segments include additives and functional products, advanced materials, chemical intermediates, and fibers. Basically, this is a behind-the-scenes business that powers dozens of industries. The company has been hit by sluggish global demand, especially in Europe and China, and by weak performance in some of its end markets like construction and consumer durables. That's led to pressure on volumes and margins, which, in turn, is dragging the stock price down. However, Eastman still generated over $9.2 billion in revenue last year, with an operating margin close to 10%. Its latest earnings show a company that's cautious but not broken. Earnings per share in recent quarters have declined year over year, largely because of volume softness and pricing headwinds. But the company is actively managing costs and streamlining operations. Free cash flow improved, and Eastman reaffirmed its commitment to returning capital to shareholders. Speaking of which, dividends are a real highlight here. Eastman has increased its dividend every year for more than a decade. It currently yields about 3.7%, and the payout is well covered by cash flow. The company has also repurchased shares consistently, a signal that management sees long-term value in the business. From a valuation perspective, Eastman is trading well below its 5-year average multiples, both on earnings and free cash flow. That could point to a short-term overreaction rather than a fundamental shift. The balance sheet is reasonably strong, with a manageable level of debt and a credit rating that supports stability. Risks? Sure, and they're not small. Weakness in global demand could persist longer than expected. The company is exposed to cyclical industries, which means it's not immune to economic downturns. Energy and raw material costs are also volatile, and if input inflation spikes again, that could hurt margins. So why even look at Eastman now? Because it's still a high-quality operator with a diversified product mix, solid cash flow, and a track record of shareholder returns. If you believe in a gradual recovery in industrial and construction activity, this might be a case of the market being overly cautious. But if the economic drag deepens, there's still downside risk. At Insightful Value, our mission is to decode the market's noise and surface companies that are quietly undervalued. We break down the financials, assess the fundamentals, and show you what's happening beneath the headlines, without the usual jargon. For more deep dives into companies like Eastman Chemical, check out insightfulvalue.com. And if you found this helpful, don't forget to like the video and subscribe to the channel for more.